Welcome back. Let's talk about the market fundamentals, where we're headed. We're so obsessed about this one level, whether the markets are going to get to its all-time high levels. But even if we go touch there, are we going to, conquer significant ground over and above these levels, or are we going to touch there and perhaps retreat, because we have seen significant outperformance and valuations too are at a premium? To discuss all this, we're joined by Jyotivardhan Jaipuria, Valentis Advisors, and we're going to get his views on the markets as well as individual sectors and the way to approach a portfolio. Jyoti, thank you very much for that. That is the question, right? What from here on? Irrespective of whether we get to that all-time high levels, we hit that 18,600, that's just one level. What about the markets on a broader scale for the next 3 to 6 months?
Yeah, Rima, so if you see, like we are there or we are close to there, 1-2% here, they don't matter. But essentially, we've had a market which has been flat for the last 1 year, which on a relative context has been great. Like India has probably been a different planet, because just given the way the world has fallen, India has done very, very well. I think the next 6 months again is going to be more driven by global factors than India, basically the Fed policy, how it goes. And second is how, the economy in the US pans out. So my guess is, the US market, Indian market, everybody will have two conflicting things. My view is inflation will come down, and so Fed will start slowing the rate increases. At the same time, there'll be enough signs that the US economy is probably slowing down, and, there'll be worries on, is it getting into a recession? So there'll be one positive, one negative. So probably, I think more flattish sort of markets ahead for the next few months also.
Okay, more flattish markets ahead for the next few months. But, it is generally in these flat market periods, in these quiet periods, where most of the money is made, right? Because in a sharply uptrending market, you generally can't catch good prices. So tell us, if one wants to invest now, where do you see both valuation as well as growth headroom?
Yeah, Sonia. So, like banks is something we've been talking about for quite some time. So I'll not repeat banks again. I think, one space which is looking very attractive to me from valuations, and they have not done well, all these segments where, commodity prices had gone up, and that's why input cost pressure was very high. At the same time, the demand environment remains strong. So what we are going to see now is last 2 quarters margins were weak for these segments. But as the commodity prices come down, margins will start reverting back to normal levels. At the same time, because the demand environment has been strong, you still have growth which continues in terms of volumes, in terms of top line growth. And with margins improving, you see good, profit growth coming through. Valuations for some of these have contracted, these shares have underperformed. So, if we get into some specific, like what are these sort of sectors, one would be, the tiles and ceramic sector, which had a massive price increases in terms of gas. So they've been starting to pass that on, and I think 2 quarters down the road, we'll probably see more normalized margins coming for them. The other is the whole wire and cable and that sort of segment where metal prices had gone up a lot. They were facing that pressure. But demand environment for all of these remains strong because the economy continues to be buoyant. So I think some of these segments are where investors should focus on, things which have done badly over the last 2-3 quarters, but which will start gaining from the benefit of commodity prices coming down.
Okay, got that. Hi, Mr. Jaipuria. This is Pavitra. So, if you're talking about stocks being available at much cheaper prices, stocks which have corrected a lot, would you look at any of the IT names now? Or do you think because of what's going on in the US and because of this impending recession, we could see much steeper cuts here, and it's still best avoided?
So, Pavitra, IT is something we've avoided for a long time because, our theme has been buy local and avoid all global stuff. Yeah. Because I think we'll have, probably like a recession in the US and a recession in Europe and UK. So to that extent, we feel more comfortable buying the domestic names. IT stocks have underperformed, so valuations are getting a little better. But even now at these valuations, I would say, given the uncertainty of the future outlook, I would still be like underweight these sectors.
Jyoti, earnings have seen a good upgrade cycle since, the troughs of COVID. Right? This quarter was pretty ho-hum, flattish, right? Some sectors did well, like banks. Some saw a bit of earnings cuts. How do you expect earnings to pan out? And in that context, do you think there is any arbitrage, any alpha that one can generate? That maybe banks will continue to outperform much higher than consensus expectations, and therefore you can still buy it from an earnings point of view?
Yeah, so, Rima, I think like it will again be the same story, buy the domestic names. So if you see this earnings season, I was, I think it went quite well. It didn't go as badly as I thought it would. A lot of the things which dragged down the earnings were the global commodities. Mainly, basically, all the steel stocks and the oil and gas companies, they're the ones which dragged down the earnings. Banks, like as you said, were the star performer. So basically, without banks, the earnings would have been negative. With banks, earnings grew like at high single digit. So I think next few quarters, banks continue to do well. A lot of the other domestic names continue to do well. What will drag earnings is going to be all these global commodity stocks, like especially steel and all these companies will struggle and they'll drag down earnings. So that's been the reason why we've been like, really pushing all the domestic names. We push the banks, we push the autos, and now, we are seeing some of these sectors domestically, which are in pain because of high commodity prices, they will start to perform now. And we've generally been avoiding the global plays.
Okay, avoiding the global plays. What about just a little more on autos, if you can help us understand, because it's a tale of two cities here, right? I mean, on one hand, companies like Tata Motors are seeing their CEOs quit, the businesses are under pressure, Europe is being hit. But on the other hand, local manufacturers, whether it's M&M, whether it's Maruti, are all doing quite well. So what do you do in pockets like this?
So, Sonia, we've been again doing exactly the same thing. Avoid stuff which is too dependent on global, buy things which are very domestic oriented, because the domestic demand is strong, especially, the urban domestic demand is strong. If you see the rural domestic demand, which is, the two-wheelers, has not been as strong. So we've been playing the four-wheelers in India, the car names, and we've been playing the CV names, because those are the things where, we can see visible demand being good. We've generally avoided everything which is, very global. In fact, even amongst auto ancillaries, we've kept like a very strict watch on how much is the component they supply outside India, how much to Europe and all. And generally, we've been a little skeptical on stuff which is going outside India, because I think Europe may get hurt the most in this global slowdown, because they are the ones bearing the whole brunt of the gas price increases and all the commodity price increases.
Okay, we will leave it at that. Jyoti, thanks for joining in and talking about the market as well as a whole host of sectors. Market, by the way, is really very quiet. Ho hum.